Target is down 45% from its all-time high, and in this video, I am going to do an in-depth analysis by looking at the financials of the company, the balance sheet, and using my Excel spreadsheet to calculate the intrinsic value of the company. Starting with the financials, this company has grown revenue between 3 and 4% over the past 5 years, excluding COVID years. Moreover, analysts are expecting them to grow at an average of 2% for the next 5 years. Their profit also jumped during COVID, and it has now stabilized. As you can see, they are currently making $3 billion of net income and free cash flow, which is what they were doing prior to COVID. When valuing this company, I think we shouldn't take COVID into account, as it was a temporary event. Excluding COVID years, this is a very consistent company. Then, in order to calculate the intrinsic value of the company, I used my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. Right now, you are seeing 6 numbers. They mean 2 things. First, that in order to make the desired annual return that I have put in, which is 12%, you need to pay these prices. I went with 12% because investing in an ETF can get you around 9 or 10%. Therefore, if you take the risk of investing in an individual stock, you should desire a higher return. And the intrinsic value, according to my low assumptions, is 93, middle 146, and high 213. For revenue growth, I did 1, 3, and 5% annually, a profit margin and free cash flow margin average of 3, 4, and 5% for the next 7 years. I assigned a PE and price to free cash flow of 15, 16, and 17, and I assumed that they buy back 2% of their shares every year because over the past 5 years, they have bought back on average 3.3% of their shares annually. The company is currently trading at $140 per share. Therefore, if the low assumptions occur, you are going to make a 5% annual return on your money. If the middle assumptions occur, 13%, and if the high assumptions occur, 20%. These returns include the dividend. Talking about dividends, this company pays a dividend of 3.1%, which is above the market average of 1.6%. The payout ratio is 56%, therefore it looks like a safe dividend. Regarding the balance sheet, this company has $1.9 billion in cash and 19 in debt. This might appear like a lot of debt. However, because they are in retail, they have a lot of leases, so I wouldn't worry about the debt. The pros of investing in this company are that the valuation looks attractive, as we have seen on the Excel spreadsheet. It is also cheap compared to its competition. Target is trading at a forward PE of 17, Walmart at a forward PE of 23, and Costco at a forward PE of 41. They are also buying back shares, and they pay a good dividend that appears safe. The only con that I have found is theft. There has been a lot of theft in retail, which has affected revenue and profit. My opinion is that this is a temporary problem that they are going to solve soon. In conclusion, I believe Target could be a good investment in the long term at the current valuation. I believe you are not going to get insane returns, but you are probably going to be able to beat the market average return of 10%. I personally don't own the stock because I believe the market as a whole is overvalued. But this is not financial advice, and you should always do your own research. I hope you enjoyed the analysis. Let me know what you think about the company in the comments, and I'll see you on the next one.